Hi there, I'm Daniel for Kalkine Media. Some of the banks that lent Elon Musk $13 billion to buy Twitter are reportedly preparing to book losses on the loans this quarter, but they are likely to do so in a way that does not become a major drag on their earnings. Banks typically sell such loans to investors at the time of the deal, but Twitter's lenders, led by Morgan Stanley, could face billions of dollars in losses if they tried to do so now, as investors shy away from buying risky debt during a period of economic uncertainty.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
Banks still have to mark the loan to its market value on their books and set aside funds for losses that are reported in quarterly results. In absence of a price determined by actual sales of the debt, each bank can decide how much to write down based on its market checks and judgment. The deliberations of how some of these banks are thinking about accounting for these losses has not been previously reported. They come as Wall Street banks are bracing for lower fourth quarter earnings due to a slump in investment banking revenue and a rise in loan loss reserves amid a weakening global economy. Three banking industry sources said the remaining $3 billion, which is unsecured, could lead to steeper losses for the 7 Twitter banks. Reuters could not determine how much the banks were planning to write down the unsecured portion of the debt. The lenders have considered replacing this unsecured part of the debt with a loan to Musk backed by his shares of Tesla, the electric car maker, according to one of the sources familiar with Musk. Musk, however, has said that it's best to avoid such loans in the current macroeconomic environment. Bloomberg previously reported the margin loan possibility. Under accounting standards, the bank must mark the loan to its market value when some of them report earnings for the fourth quarter in January. But with market activity coming to a standstill, the banks have a fair amount of flexibility on how to value them, which means each one could value them differently. Each bank would make market checks with 2 or 3 potential buyers to arrive at the value of the loans, which an auditor would have to agree with. Meanwhile, projected losses could also be divided between investment banking and trading divisions, making it small enough that it doesn't have to be disclosed separately, and any write-downs would probably be broken into chunks and spread over several months, reducing the hit to earnings in any one quarter. Some market participants expect the losses from the debt to be significant unless market conditions improve. 2 of the banking industry sources said to Reuters if the banks tried to sell the loans now, they would not get more than 60 cents to the dollar on the secured bond and even lower price on the unsecured portion. That would add up to billions of dollars in losses for the syndicate as a whole. Well, that's all for now. Leave your thoughts in the comments and don't forget to like and subscribe and hit that bell icon for future notifications. I'm Daniel for Kalkine Media.